The implied open is flashing bright red right now. We are looking at S&P 500 futures down over 0.5% in the overnight session, and the Nasdaq 100 is leading that broader slide. It's down nearly 1%.
Yeah, and the overnight catalyst driving this drop is just the bond market violently waking up.
Right.
I mean, the 10-year Treasury yield surged to a 16-month high of 4.68% pre-market. And if you look at the 30-year yield, it touched 5.20% yesterday. That is the highest borrowing cost for long-term capital since the eve of the Great Financial Crisis in 2007.
Which is staggering. We are facing a market that is just pinned between the euphoria of the AI boom and a brutal new macroeconomic reality.
Right.
So today's deep dive is going to map the exact structural fault lines beneath this morning's pre-market volume.
Because the gravity of that bond market move, it's the single most important factor dictating institutional flow right now.
Absolutely.
If we look at the mechanics of why a 4.68% 10-year yield crushes the Nasdaq, it comes down to how growth stocks are valued. I mean, tech valuations are entirely predicated on future cash flows.
Right, because when you can park billions in U.S. government paper and get a nearly 5%, quote-unquote, risk-free return, the mathematical formula used to discount those future tech earnings back into today's dollars becomes deeply unforgiving.
Exactly. The higher the yield, the less those future earnings are worth today. Valuations compress immediately.
And that yield compression is, well, it's only half the macro vice currently squeezing the broader market, because the U.S. dollar index, the DXY, is simultaneously spiking to a 6-week high of 99.38.
Yeah.
And this is being driven by severe geopolitical static, specifically those renewed threats of the Strait of Hormuz closing. When a major global oil choke point is threatened, oil spikes. We're looking at $110 a barrel this morning.
Which reignites base-level inflation fears.
Exactly, which drives a flight to the safety of the U.S. dollar.
But the real risk here for multinational megacaps, especially the tech giants leading the index, is what that strong dollar actually does to their balance sheets. Because when the DXY is sitting near 100, international revenue translates back into significantly fewer U.S. dollars. We are looking at an environment where big tech is spending unprecedented, record-breaking amounts of capital on AI infrastructure, while their overseas profit margins are simultaneously being eroded by currency exchange rates.
Which puts an incredible spotlight on the elephant in the room at 2:00 p.m. Eastern today. The Federal Open Market Committee minutes.
Oh, yeah.
This is our first detailed institutional look at the post-Jerome Powell era under the new Fed chair, Kevin Warsh. And the overarching theme defining Warsh's approach is this stay-in-your-lane doctrine.
Right, which is a massive paradigm shift.
It is. For anyone managing a 401k or an active trading account, you have essentially been conditioned over the last decade to believe in the Fed put. The idea that if equities drop far enough, the central bank is just going to step in, cut rates, and rescue asset prices.
Yeah, but Warsh is signaling the absolute death of the Fed put. He is drawing a hard boundary. Warsh's mandate is price stability and employment. Full stop.
Okay.
Propping up the S&P 500 is no longer part of the implicit equation. I mean, with oil at $110 fueling those inflation fears, he is actually forced to lean hawkish here.
Which means he favors aggressive quantitative tightening. QT, and accelerating the sell-off of the Fed's massive $6.7 trillion balance sheet.
Exactly. Think of the stock market's liquidity like a massive reservoir. For years, the Fed has been pumping water into it to keep everything afloat. Warsh isn't just turning off the hose, he's actively opening the drain at the bottom.
And that drain creates a massive vulnerability for retail investors, setting up what institutional desks are calling today's pain trade.
Yeah, the pain trade is brutal right now.
It is. A pain trade happens when the market moves violently in the exact opposite direction of how the majority of participants are positioned. Right now, everyday investors are heavily positioned for a rate pause or, even a pivot back to easy money.
Which is crazy given the data.
Right. They are holding highly inflated growth stocks, expecting that reservoir to stay full. If Warsh confirms he is accelerating asset sales and pulling that liquidity out of the system, the exit door for all those retail positions is going to shrink to the size of a keyhole.
Which is exactly why the technical internals of the market are fracturing before the bell even rings. The foundational plumbing is giving way under the pressure of that expected liquidity drain.
We see this explicitly in the S&P 500 futures.
Yeah.
We broke the primary bull channel that has held since April.
Yeah.
Creating a classic look above and fail trap at the critical 7,500 psychological level.
Right, and let's unpack the mechanics of that 7,500 trap.
Please do, because honestly, a 0.57% drop pre-market doesn't sound inherently apocalyptic on paper.
It doesn't, but structurally it creates a massive ceiling of overhead supply. When the index pushed past 7,100, it triggered algorithmic buying and a massive wave of retail FOMO. People rushed in, assuming a new breakout was confirmed. But because the underlying liquidity wasn't actually there to support it, the price immediately collapsed back below the line. And now every single participant who bought at the top of that 7,500 breakout is holding a losing position.
They are trapped.
They are completely trapped. This is why traders are being warned not to chase the morning pop. When the market opens and inevitably experiences a small reflexive rally, it isn't new buyers stepping in with conviction.
No.
It is simply those trapped late-cycle buyers using the slight bounce as an opportunity to sell and break even, and that creates relentless downward pressure.
And that pressure is heavily reflected in market breadth. The internal data shows less than 50% of the stocks in the S&P 500 are currently trading above their 200-day moving average.
Which is wild.
It's a huge divergence. The heavyweight megacaps have masked the reality that more than half the actual companies inside the index are already in a confirmed long-term downtrend.
Yeah, it is a Jenga tower missing its bottom blocks. That is why defining the levels today is paramount. For the S&P, the immediate line in the sand is 7,400. But the real danger zone is the 7,320 support. If we slice through 7,320, we trigger the trapdoor.
And at that level, institutional risk management algorithms are programmed to blindly sell to protect capital, right? Which can cascade into a violent, uncontrolled liquidation event.
Exactly. And the Nasdaq 100 is already flashing warning signs of that liquidation. It's staring down a must-reclaim line of 28,900. We are watching pre-market volume aggressively rotate out of the AI infrastructure trade and into defensive sectors like healthcare and value stocks.
But that rotation is the direct consequence of the 4.68% yield we started with. Institutional portfolio managers aren't just going to cash, they are seeking yield protection.
Right.
Healthcare and consumer staples offer reliable dividends and, inelastic demand that performs well, even when the cost of capital is suffocating the tech sector.
Yeah, yet despite this massive macro-level rotation and the crushing weight of the bond market, there's exactly one single company holding the entire market hostage today.
Cool, the main event.
NVDA. They report their fiscal year 2027 Q1 earnings after the bell, and the sheer velocity of capital moving through this one ticker is unprecedented in financial history.
It's almost hard to comprehend.
It really is. Consensus estimates demand $78 to $79 billion in quarterly revenue. That's a 77% jump year over year, with earnings per share of $1.78.
And the options market is currently pricing in a 6.5% implied move on the stock following the print. To put that percentage into absolute terms, we are talking about a $350 billion swing in market capitalization.
Yeah.
NVIDIA could literally add or erase the equivalent of the entire enterprise value of Bank of America or Home Depot in a single after-hour session.
Because NVIDIA's weighting in the major indices is so utterly dominant, the S&P 500 options chain is implying a 1.23% move for the entire index purely based on this one earnings report.
Wow.
The entire U.S. stock market is effectively riding in the passenger seat of NVIDIA's balance sheet right now. For the day traders, the immediate support sits at $220.40, with resistance up at $231.50.
And if they beat the top and bottom line, we could see a squeeze toward 250.
We could.
But the fundamental reality of this specific print is that past revenue is entirely irrelevant to Wall Street right now. The market is exclusively forward-looking, and the absolute focus will be the forward guidance on the supply chain for their next-generation Blackwell and Rubin GPUs.
Exactly. Global demand for AI compute is essentially infinite right now, so the only variable that actually matters is manufacturing bottlenecking.
Which raises the ultimate tension of the day. In a dovish macro environment, a standard top-line revenue beat would be enough to trigger a massive gap-and-go rally. But we are not in a dovish environment.
No, we are definitely not.
With a 10-year Treasury yield strangling valuations and a hawkish Fed chair actively draining the liquidity reservoir, absolute perfection is the absolute baseline.
Right.
If NVIDIA's supply chain guidance falters by a single millimeter, that $350 billion implied move will snap to the downside, and it will drag the entire 28,900 Nasdaq level down with it.
We actually have a secondary, highly revealing data point on the state of AI infrastructure demand this morning, too. Iron Mountain, ticker IRM, is exercising a green shoe provision in their convertible notes offering.
Right. And a green shoe allows underwriters to sell more debt than originally planned because institutional demand for the offering vastly exceeded expectations.
Yeah, and Iron Mountain handles massive data storage and physical data centers. The fact that they can upsize a debt offering right now proves that robust institutional liquidity is still blindly flowing into the physical plumbing of the AI buildout, regardless of rising interest rates.
It sets up a fascinating collision.
Mm.
You have a generational secular AI infrastructure boom smashing headfirst into a highly restrictive, cyclical macroeconomic wall.
And that collision is going to dictate market direction for the next 6 months. But, while we wait for NVIDIA to resolve the AI side of the equation, the early pre-market movers are offering us critical real-time data on the other side of the economy, the consumer.
Let's pull up Target, ticker TGT, which is highly active in the pre-market following their Q1 print. They delivered $24.64 billion in revenue, but the internal metrics are pretty grim.
Yeah, they are.
They're actively revising their forward guidance downward, citing a highly selective middle-class consumer.
And selective is just the sanitized corporate terminology for a consumer base that is completely tapped out.
Right.
When everyday shoppers are absorbing the reality of $110 oil at the gas pump and facing higher variable interest rates on their credit cards, the first thing they cut is discretionary spending. They stop buying the high-margin electronics and patio furniture, and they restrict their purchasing entirely to low-margin groceries and absolute essentials.
Exactly.
That downward guidance from Target is a massive macroeconomic red flag.
But if we look at the restaurant sector, we see a glaring contradiction. Key AV Group is gapping up 7% pre-market on a massive Q1 beat. Revenue jumped 32.2% to $434.4 million. Same restaurant sales are up nearly 10%, and actual foot traffic is up 6.8%.
It's incredible.
They are completely defying the gravity of the fast casual space. And the immediate technical hurdle they must reclaim today is the $83 resistance level. So how do we reconcile a middle class that is too tapped out to buy a television at Target, but is simultaneously driving a 30% revenue spike at a premium fast casual chain?
Well, it is the perfect execution of the lipstick effect adapted for the modern dining sector. When the macroeconomic vice tightens, consumer psychology shifts.
Right.
People realize they cannot afford the large, durable luxury goods. They cancel the vacation, they hold off on the new car, they skip the big-ticket items at Target. But human nature dictates that they still need to treat themselves. They still require small, affordable indulgences just to maintain a sense of normalcy.
So they pivot their discretionary capital from major goods to micro experiences. A $15 bowl at Key AVA feels premium compared to traditional fast food, but it's vastly cheaper than a sit-down restaurant.
Exactly.
They aren't broke. They are just ruthlessly optimizing how they deploy their remaining liquidity.
Precisely. CAVA has positioned itself perfectly to capture the exact demographic that is trading down from high-end dining, while simultaneously capturing the demographic trading up for an affordable luxury.
And moving back to the tech side of the pre-market tape, we have 8x8 Inc., ticker EGHT, surging 13.7% this morning. They just delivered adjusted earnings of 11 cents per share.
Yeah.
In a market totally obsessed with AI semiconductors, a legacy cloud communications provider popping 13% is a crucial signal.
It proves that the market will still reward non-AI software companies, provided they can prove actual bottom-line profitability.
Right, because in a zero interest rate environment, companies could survive purely on revenue growth and the promise of future earnings. But with yields at 4.68%, the market demands immediate cash flow.
Yeah, 8x8 delivered an actual 11 cent per share profit, and capital immediately flowed toward that certainty.
Finally, we have to look at the structural pressure hitting Tesla, ticker TSLA. They're riding a 4-day losing streak into the open, hovering precariously near a critical $412 pivot point.
Yeah.
And the immediate catalyst dragging them down isn't related to their auto sales. It is the impending announcement of a SpaceX IPO.
Which is just a perfect example of how finite liquidity pools operate within the market. I mean, Elon Musk has cultivated a massive, highly dedicated base of retail and institutional shareholders.
Yes, he has.
But that specific capital pool is not infinite. So when SpaceX, which is arguably the most anticipated, culturally dominant private company in the world, announces it is going public, that capital has to come from somewhere.
Right. You are looking at millions of retail accounts that hold Tesla stock. When the SpaceX IPO opens, those investors are going to actively liquidate portions of their Tesla positions just to free up the cash required to buy into SpaceX.
Yeah.
The IPO is literally cannibalizing the liquidity of its sister company.
It is a zero-sum capital drain. If Tesla drops below that $412 pivot, institutional algorithms view it as a breakdown of long-term support, and they will begin shorting the stock, which just accelerates the retail sell-off. However, the bullish counterweight here is their aggressive hiring surge in China for their full self-driving infrastructure. They are targeting regulatory approval by Q3 of 2026.
And if they secure autonomous driving approval in the largest EV market on the globe, the foundational valuation of the company instantly shifts from a traditional hardware manufacturer to a high-margin software and robotics monopoly.
Massive shift.
So the battle at that $412 pivot today is essentially a tug-of-war between the short-term liquidity drain of the SpaceX IPO and the long-term monumental upside of Chinese FSD approval.
It perfectly mirrors the broader market tension we are seeing across the board this morning.
It really does. It all comes back to that underlying fragility. We are heading into an opening bell where the S&P 500 is completely bifurcated. You have the euphoric, seemingly unstoppable momentum of the AI build-out, quantified by NVIDIA's impending earnings and data center debt offerings. And it is crashing directly into a macroeconomic wall built on $110 oil, bond yields pushing back to 2007 levels, and a Federal Reserve that is preparing to drain the underlying liquidity that has kept this market afloat for a decade. If a single chip maker's earnings report can dictate the immediate direction of global finance, completely overpower the gravitational pull of $110 oil, 16-month high Treasury yields, and a hawkish new Fed regime, are you actually investing in a truly diversified, resilient stock market? Or have we simply transformed the major indices into a complex, highly leveraged derivative of the AI industry?
Something to think about.
Definitely something to think about as you navigate the pre-market volume today. Thanks for joining us on this morning's Deep Dive. Map out your levels, and we will see you next time.